Welcome back to IMF-World Bank Week at the Atlantic Council. This is day 5, the final day of our programming. Thank you for being with us throughout the week. We have had a tradition here the past 3 cycles of hosting Megan Greene, external member, Monetary Policy Committee of the Bank of England. We couldn't wrap up an IMF Week at the Atlantic Council without having you, Megan. Appreciate you being here during such a busy week.
Yeah, thanks so much for having me.
So let's jump right in and let's talk about the situation in the UK. In the WEO, the UK was downgraded to 1.1% GDP growth in 2025, along with almost every other major advanced economy in the world.
Right.
Inflation expectations are higher. I think we're looking around 3.4% in the UK. The Bank of England held rates steady at the last meeting at 4.5%. And so the question on my mind, I think on everyone's mind, is what are you looking toward as you head into the May meeting in 2 weeks?
Yeah, thanks so much. And I fly back this weekend to start another round next week. For the UK economy, it's been downgraded, but I think it's important to highlight that there hasn't really been any growth in activity in about 9 months now. And there's a huge uncertainty around that, so we know growth is weak, but we're not quite sure if it's supply or demand driven, and there are perfectly reasonable narratives for both. So on the demand side, you could say there was all this policy uncertainty, domestic policy uncertainty before the budget. That's been compounded by foreign policy uncertainty. Confidence has fallen, so people just aren't spending, businesses aren't investing. That could be a demand-driven reason why activity's been so weak. I'm a little bit more worried about the supply side, actually, and it's harder to really explain fluctuations in the supply side of the economy because you can't really measure potential output, you can't really measure potential productivity growth, but we've had really weak productivity growth in the UK. And in our forecasts, which is what we have to use to set policy, we have productivity growth recovering to trend. And I have concerns about that assumption. So if the supply side is constrained, then all else equal, that ends up being inflationary. And so I am worried about that. On the domestic policy front, we have seen inflation come down towards our 2% target, and I think that trend is continuing. I'm worried about the supply side. There's also a big uncertainty around the implications of the budget on the economy, and particularly higher labor
tax
costs.
Cuts you're talking about,
So it's higher labor costs, actually. There was an increase in the national insurance contributions and the national living wage, and so we don't quite know what firms are going to do with that. They'll have to adjust, but they could adjust by eating their, having it eat into their margins. They could adjust by hiring fewer people, having people work fewer hours, paying them less. Investing to try to boost productivity growth. And when we ask firms how they're going to adjust and lay out those margins of adjustment, they kind of just say yes. We're going to do all of them. So it's still unclear, but it's very different implications for inflation. So if there's a shakeout in the labor market, then that would ultimately hit demand and would be disinflationary.
Yeah, I'm trying to push through, as you're saying, the inflationary impulses versus the disinflationary impulses. And do you see the balance tipping one way or the other?
Yeah, so I have been more worried about kind of the structural factors, and particularly on the supply side.
So more the inflationary impulses.
That's right, which on balance would be inflationary. But of course, as we know in the IMF meetings this week, we live in this global economy, and so there are a whole bunch of other factors coming into play now as well.
Well, let's talk about those other factors. You have a new op-ed in the Financial Times out this morning talking about uncertainty. Governor Bailey earlier this week talked about shock to the UK economy given what's happening. Can you walk through the uncertainties? Because we just talked about the UK situation and the different crosswinds, but there are other headwinds, as we've been talking about all week, happening all around us here at the IMF. Yeah,
that's right. And so, I walked through some of our uncertainties domestically, but there are big ones globally. And for the UK, it's worth pointing out that the UK's biggest single country trading partner is the US, but its biggest trading partner overall is actually the EU. And so what's going on in the US and the EU is quite important for the UK economy. On the EU side, we have a whole bunch of fiscal spending that seems like it might come through the pipe, particularly on defense and infrastructure in Germany. And so that should be a bit of a tailwind for the UK. But of course, on the other hand, we have tariffs, and none of us have any idea what they'll look like when the dust finally settles. But if you think about kind of the channels through which tariffs might ultimately hit the UK economy, they have both inflationary and disinflationary impulses as well. So you could have export substitution. So if there are US tariffs on the UK, then US consumers find US domestic substitutes rather than importing from the UK. That would be disinflationary for the UK economy.
But you also see other countries, they could trade diversion, as you've talked about, and increased interest.
That's right. So there's trade diversion, and that could mean, cheap goods coming from Asia, finding a market, so that would be disinflationary. It could also mean the UK has lower tariffs than other developed economies, and actually that would boost growth and could boost inflation as well. So that's highly uncertain. Also, we saw during the pandemic that if you disrupt supply chains, that tends to be inflationary. And if you have, trade fragmentation writ large, that reduces knowledge spillovers, that tends to reduce potential growth, all else equal, that's inflationary. What it really comes down to is probably exchange rates.
That's to ask you.
That's right. That's a key difference. And so normally, if the U.S. were to impose tariffs on the U.K., you would expect the U.S. dollar to appreciate. That hasn't, in fact, happened. In fact, the opposite has happened. I mentioned that the U.S. is the biggest trade partner, but the EU is quite important as well. And the euro has actually gone in the other direction. So for the trade-weighted sterling exchange rate index, it hasn't moved as much as you might expect. But a lot comes down to what you think will actually happen with the dollar. If it continues to depreciate, then that would, on balance, be disinflationary for the UK economy. If it rallies, then the opposite would be the case.
If you had to predict, which is dangerous right now, which way do you think it's heading? Because it has confounded expectations based on what a macroeconomic textbook would tell you.
That's right. So it's really difficult. If you look at other crises, if you look at the global financial crisis or COVID, actually, Lehman, the dollar depreciated after those events as well, and then ultimately rallied. We're not seeing kind of textbook economics play out here necessarily, but there is some precedent for that. And so I really think it's too early to say what's going to happen with the dollar.
Is it fair to characterize what you're saying is despite the shocks happening around the world, trade war shocks, you're not seeing anything from your perspective that's driving you that there would be a change in what you previously thought in terms of the rate path in the UK?
So I think that's right. In my mind, the risk space has changed a little bit. So particularly around tariffs, I think the risk is now on the disinflationary side. So I think that tariffs on the UK would on net be more disinflationary than they are inflationary, and so that is a challenge, but it's in the risk space given that we don't quite know what tariffs are going to look like in the end.
No, that makes sense, and it's helpful to hear because you've been a more hawkish member of the Monetary Policy Committee, so it's helpful to see how things have changed, understanding it's an evolving situation. Yeah. Let's talk a little bit about Treasury markets, and I'm very curious for your perspective on what's happening here. I remember when we met 6 months ago, I have the quote here, you described the drunken dragon of the U.S. Treasury market. At the time, I kind of reacted strongly to that, but I think you were prescient, given what we all experienced in the past few weeks. So I guess my question, Megan, is how drunk is the dragon right now?
I mean, the Treasury market has been moving a lot over the past couple of weeks, and that matters for a small open economy like the UK quite a lot. That affects our financial conditions. In normal times, about a third of the moves in the gilt market come from things happening entirely outside the UK. More recently, it's been about half. And so when the Treasury market moves, often that spills over into the UK, even though it has absolutely nothing to do with UK fundamentals. But we can't ignore it because it does affect financial conditions in the UK. And so that is something that we're going to have to continue to look at.
What was your perception of what was happening a few weeks ago? We had a really stressful moment in the bond markets here with the yields going up very quickly, and then the president backtracked on some of the tariffs, not all. Just watching that from afar as someone who understands Treasury markets and does monetary policy in the UK, were you observing it in real time? What was your thought as this was developing? It's about 2 weeks ago now. It feels like longer.
Well, as a former market participant, of course, I was watching it. But, in my role as an MPC member, I was also watching what happened to the gilt curve, and it moved quite a lot as well. And again, currencies have moved a lot. On all of it, I think it's really too early to say what this will look like when the dust is settled. It's really difficult to predict this stuff under normal circumstances, but when you have policy and major policies evolving so quickly, it makes it even more difficult to forecast where this is going. For what it's worth, at the Bank of England, we actually take market pricing for things like the gilt curve, and so we don't speculate on where it's going to be. We just take what the markets are pricing in.
I'm thinking about something Chair Powell said a week ago. We've had basically 100 years since we've had tariff rates like this in the U.S., Smoot-Hawley, and we're above that now as effective tariff rate. And he said for the Fed, it's almost impossible to model this. And I was struck by that. I know the IMF has done their best to model this week in the WEO. How does the Bank of England think about the uncertainties in modeling going forward?
It is really difficult to model this kind of thing, not only because it's so volatile, but also because models don't really know how to handle this and see shocks propagate. What we end up doing is using a whole bunch of different kinds of models to try to figure out what the implications might be on the UK economy. So in the FT column that I published, which was based on a speech I did, I actually leaned heavily on staff work, which used the ECB's global model to try to figure out the propagation of tariff shocks. And so I think cross-checking with a whole bunch of different models is one way. Another thing that we're doing at the Bank of England, of course, is scenario analysis, and this is in response to the Bernanke review to some degree, although we've always talked about scenarios. We're fleshing them out in a bit more detail these days, and that helps us think through all the risks because we are surrounded by them.
You walked through, last time we met, these 3 scenarios, I remember, of how the world could evolve. Has your thinking changed at all in the past 6 months in terms of more fractured reality, less fractured, and the dynamic going forward?
So it hasn't changed for me. Previously I thought we would have to see an output gap open up to bear on inflation and bring inflation sustainably to our target. I think that's still the case, and in fact I think we are starting to see an output gap open up, and that should bring inflation down to our target over the next 2 to 3 years. So I still think that's the case. There's another case which is a bit more structural, which suggests that kind of the longer neutral rate has shifted. NAIRU, the natural rate of unemployment has shifted. Potential output has shifted, and I think that's a worry again with my concerns about the supply side, the very constrained supply side of the UK economy. But I put more weight on this notion that actually we just need to see an output gap open up, and we should be able to bring inflation to our target.
Okay, let's talk about China. Obviously, UK-China relationship important, and the US-China relationship is what's dominating the conversation here. How do you think about the spillovers from a trade war between the world's 2 largest economies and the connections between the UK and the Chinese economy?
So, as I mentioned, the US and the EU are the biggest trade partners, but of course China is a big trade partner for the UK as well. And given where tariffs currently are between the US and the UK, it's effectively an embargo. So we do expect to see some trade diversion coming from Asia, and that could in and of itself be disinflationary for the UK economy. But again, for the UK economy, given it is such an open economy, the tariffs on the UK directly matter, but everybody else's reaction to them also matters quite a lot for the UK economy. So ultimately, we don't know where these tariffs will end up, but I do think that we should see some trade diversion coming from China.
We've been talking to a lot of European central bankers on this, and obviously your perspective as well. This seems to be a rising fear from what I can take from the meeting so far. And is that time frame, is that weeks, is that months? Do you have a sense of when that trade diversion happens, or it's too hard to say?
It's really hard to say, and again, different models have this propagate at different speeds, and none of them is perfect. But I do think, we should see it in months for sure, but we could see it more quickly. I mean, you hear about kind of shipping container data coming into the port of Los Angeles that's significantly down on where it had been previously. So I do think that some of this could happen quite quickly.
Just taking a step back for a second, what does it mean for a small open market economy like the UK, an island economy, as you have said before, to live in a world of higher protectionism, higher tariffs? Whatever happens in terms of the White House policy, we're going to have a higher effective tariff rate in this country than we had before. How do you think about that, not just for the May meeting and the next 6 months, but long term on UK growth outlook?
Yeah, so it's a great question. I think some of it depends on where exactly the trade-weighted average tariff rate is. Where it is now, I think, is pretty significant for many economies. If it were to come down, I think there is some space for absorption of higher tariffs than where we were, 6 months ago, for example. But with a longer-term perspective, I do think that what we're seeing is the continued increase of kind of economic statecraft, and that does represent a series of supply shocks for a number of economies. And so, you have a whole generation of economists who have grown up only looking at the demand side of the economy. We learned during COVID and the invasion of Ukraine that actually we need to look at supply shocks as well. It's much more difficult to measure some of these supply shocks, and it's hard to know as a central banker what to do with them because, we don't have great tools to deal with energy costs changing, for example. But I do think this increased protectionism, the use of restrictions and tariffs, does mean that we are looking at a kind of medium-term world where we do have more supply-side shocks in the economy.
This is what I picked up this week as well. Everyone trying to distinguish between the global financial crisis and whatever we're walking into right now. And central banks reacting differently in, I think, a more wait-and-see mode. Is that fair to say?
Yeah, I think that's right. I mean, that was an immediate financial crisis. This is a very different kind of crisis at the moment, at least. And so you do need to worry about how this might feed through financial markets, but that still exists as a risk rather than something you would actually set policy based on.
So just going back to the UK for a second, two questions, one on inflation and one on the labor market. If we didn't have the trade war, if we were just meeting here and the effective tariff rate of the United States was 2.5%, what it was in January, hard to believe that that's where we were, not over 20%.
Yeah.
You still were seeing higher inflation than expected in the UK.
Yeah.
You talked about some of the drivers of that, but can you unpack it a little more from us, the world before tariffs?
Yeah, sure. So inflation in the UK has been higher. The really enduring component of that has been services inflation, which also tends to be more domestically driven. If you look at what's feeding into services inflation, the biggest component is actually wage growth, and so you need to look at the labor market to figure out what's going on with wages. The biggest piece of that, actually, in wage growth, or a significant piece of that, is inflation expectations, which we, as you mentioned earlier, we've seen rising. Household inflation expectations have been rising, both the 1 year and the 5 year, which is the 5 years a bit more surprising. So there is a slight concern that people are maybe just a bit more sensitive to inflation, given the bout that we've just come through, than normal times. And so maybe people are concerned about inflation coming up because inflation has been ticking up in the UK, and we expect a near-term hump in inflation that should peak in the third quarter of this year and then come back down. But it is a concern that you could end up with sort of second-round effects from that. On balance, I don't believe that will happen because we're in a very different environment. The labor market is loosening. Inflation's much lower than it was at its peak when it was over 11%. So it's again, this fits into risk space. It's not my base case scenario, but it's something that we need to watch for sure.
And on the labor market itself, I've heard you talk about data and collection in the labor market, and I think that's a very interesting point to understand. We think what we know we're seeing in the labor market, but there's more uncertainty perhaps on the collection side than pre-COVID.
There is, in the UK, more so than in many other developed economies because the responses to the labor force survey have fallen pretty significantly since COVID. It's a good question. It's been falling actually everywhere, so that is not in and of itself a purely UK issue, but it has fallen more in the UK than elsewhere, and the ONS is certainly working on that. But it does mean that we have less visibility into important things like unemployment and inactivity. That said, we're not flying blind. We have a whole bunch of other indicators that we can look at. Some of them are sort of real-time data, like Indeed's data. Some of it is tax data. Some of it is, bank-built indicators that are based on surveys to try to extract some signal from the noise. And so, the labor market, as I mentioned, has been weakening. It's been weakening pretty slowly in the UK as it has been elsewhere. Unemployment is it's just under 4.5%, which is actually pretty low. Employment growth has been weakening as well. We expect that as the labor market continues to loosen, we should see wage growth come down, and we get that. Our agents ask firms how they're planning on setting pay settlements over the next year, and they have it coming in at around 3.7%, which is a pretty big...
And is this all pre-trade war shock, this data?
This is all pre-trade war, that's right.
Okay. When will you get the next wave of data on that front?
So the really important one for us is the April pay settlement data, but because there's a lag, we won't fully have that probably until June. We also ask firms what their year ahead expected wage growth is, and they've been stuck at around 4%. So we have some good indications that wage growth should continue to come down, but actually these figures are still above what would actually be consistent with a 2% inflation target. So we'll need to see it come down further.
So one more question on the UK side, fiscal side of the house, how you're seeing this government's priorities factor in to the inflation picture. We're looking at potential increased defense spending. A range of countries have been asked to do that by the United States, looking at budget cuts, different priorities. We just heard from the Chancellor earlier today. I know she's meeting with Secretary Bessent later today. How do you factor this in? Because this new government here in the UK has come in with their own set of policy priorities, which are obviously impacting the economy.
Yeah, they do. So how we handle fiscal developments is that we bake it into our forecasts as soon as they've been announced and legislated. So we don't speculate on what's coming. We just consider what's actually going to happen and build that into our forecast. So what we've seen is that we should see the fiscal policy contribute less to growth over the forecast period, but it's still contributing to growth.
Understood. Let's talk about the IMF for a minute. Governor Bailey reacted to Secretary Besset's speech, which was calling on the IMF and the World Bank for reforms. Yeah. These are long-standing calls from the U.S. and other countries in terms of a return to mandate kind of concept for the IMF. I'm curious your perspective on what the fund should do going forward in its mission.
So I think what's important is that the Bretton Woods system persists, and I think there was some concern that some member states, particularly the U.S., might decide not to participate. And so I also think that the Treasury Secretary's suggestion that the U.S. would consider staying as long as the mandate were really more narrow for the IMF and the World Bank. I think that's good news. I think it's important for the U.S. to contribute to the Bretton Woods institutions. And that goes both in terms of kind of intellectual content, the U.S. being able to support the countries that it wants to, but to get back at our previous discussion about tariffs, I think there would also be implications for the dollar if the U.S. were to withdraw from the IMF. And so I also welcome the news that that doesn't seem to be on the table for now.
I'm so happy you said that. This hasn't come up in any of our events, but I've been thinking about the same thing, about even the threat of a U.S. withdrawal, if that would happen, and thankfully it didn't this week, and we hope it doesn't. I imagine that would have a market-moving reaction in terms of emerging markets and countries that rely on IMF support. But it's interesting, just the idea that if the U.S. said that, regardless of doing it, I think you would see reaction around the world.
You would. There's a great column in the Financial Times by Ted Truman on this as well, and he is a real expert on this. I think there would be implications, not just in terms of sentiment, but also in terms of the IMF, doing a lot of its business in dollars, as it turns out.
SDR conversion into dollars.
That's right. That's right. And also, if we're talking about SDRs, the dollar is a huge piece of that basket, and so if the U.S. were to withdraw from the IMF, then the basket might be reshuffled, and that would have implications for currencies as well.
So uncertainty abound. You made this very clear in the Financial Times piece today, which I encourage everyone to look at. What are you optimistic about? What have you come away from this week feeling better than you walked in with, if anything?
Yeah, it's funny. It's often hard to come up with a positive coming out of the IMF meetings, but it's because I'm an economist and it's the dismal science, so we spend a lot of our time.
Bank, it's easier. That's
right. Yeah, that's right. We often worry about things. It does seem like there is some opportunity. It feels like there are some real shifts in terms of kind of economic thinking these days, but there's also opportunity to kind of rethink some things and try to consider how we might go ahead and boost living standards across the developed and the developing world.
So you see a path that maybe this goes to a place where we settle in something that's different than we were before, but can also still contribute to global growth in a meaningful way. That seems to be what the debate has been so far this week.
That's right. I think it is possible. I think everyone's going to have to make some adjustments if indeed we are moving to a slightly different structure of economic thinking. And it's too soon to say whether that's the case or not. But of course, we will all have to adjust and figure out how to best hit our mandates and to boost living standards.
Well, considering the UK and the US were the founders of this Bretton Woods system, we appreciate you being here. We appreciate the Bank of England's work. Thank you for your time, Megan, and thank you for everyone for joining us. We have a series of events throughout the day, including my colleague Charles Litchfield on Basel III Endgame shortly, and then Adina Friedman, NASDAQ President and CEO at the Atlantic Council Global Headquarters at 11:30. So stay with us through the rest of the day. Thank you for being with us, and we wish you a pleasant rest of the day.